Do you know this trader? His name is Munehisa Homa, the man who made over $10 billion in today's money, using nothing but candlestick patterns. I've spent months studying his original methods and trading philosophy, decoding how he used simple candles to predict price movements with incredible accuracy. And today, I'll show you the exact candlestick patterns he created and used, and how you can apply them too to drastically transform your trading results. In this video, you will learn the secret method Munehisa Homa used to read market psychology, how to trade like Homa using the Marubozu candle, how to use the Tonkachi and Nagariboshi to spot trend reversals, how to use the Harami and Doji to join strong trends at the perfect moment, how to trade using the Sakata 5 method, two powerful day trading strategies combining ancient wisdom and smart money concepts, the Sansen, Tsutsumi and liquidity sweep trading strategy, the Sanpei Age, Tonkachi and fair value gap trading strategy. By the end of this video, you will be able to read market psychology through candlestick patterns, predict trend reversals before they even happen, use one of the most powerful trading methods in history. These strategies work for day trading and swing trading. It can be applied to all markets, forex, stocks, crypto, commodities, and futures. Before we get started, don't forget to like this video, subscribe to the channel, and hit the notification bell so you never miss the next trading lesson. Let's get started. Before we dive into the patterns themselves, let's start with the basics. What exactly is a candlestick? A candlestick is a visual representation of price movement within a specific period of time. It shows four key pieces of information: the opening price, the closing price, the highest price, and the lowest price during that period. The rectangular part of the candle is called the body, and it represents the range between the open and close. The thin lines extending from it, known as wicks or shadows, show how far price moved above and below that range. When the closing price is higher than the opening, the candle is usually shown in green or white, meaning buyers were in control. When it closes lower, the candle is red or black, meaning sellers dominated. So, in simple terms, every candle tells a story of a battle between buyers and sellers, who entered, who won, and who lost. And when you combine multiple candles together, those stories form patterns that reveal the market's next move before it even happens. The very first candlestick Munehisa Homa relied on was called Marubozu, which literally means a shaved head in Japanese. It's a candle with no wicks, just a full body from open to close, pure momentum, pure conviction. Homa once wrote, "When the market shows no shadow, it shows no doubt." In other words, when price moves from open to close in one clean direction, it reveals total dominance. No hesitation, no rejection, no confusion. To Homa, the bullish Marubozu was the market's way of shouting, "Buyers are in complete control," and the bearish Marubozu was the opposite, a candle that whispered, "Sellers have taken over the battlefield." Centuries later, this same principle still applies. A Marubozu candle often signals the start of a strong trend or the continuation of an existing one. It's not just a green or red candle, it's a visual expression of human emotion, captured in one move. Look at this chart example. The market was in a clear downtrend, moving lower step by step. Then it began to consolidate, forming several small candles, a pause in momentum where neither side had control. After that, price broke below the consolidation zone, continuing in the direction of the trend. It then pulled back slightly, and right at that point, a strong Marubozu candle appeared. Notice how this candle has almost no upper or lower wick, just a full body from open to close. That tells us sellers stepped in with total confidence, completely overpowering the buyers. As Munehisa Homa said, "When the market shows no shadow, it shows no doubt." And look at what happened next. The market dropped sharply, proving that this bearish Marubozu wasn't just another red candle. It was a clear message from the market. Sellers are fully in control, and the trend is far from over. Look at another chart example. Here, the market was trending upward, then it hit this level and reversed slightly before moving back up again. As price approached that same level once more, 4 doji candles appeared. Okay, by the way, a doji is one of the candlestick formations used by Munehisa Homa, and we'll cover it in more detail later in this video. A doji represents indecision, a moment when buyers and sellers are perfectly balanced and the market is waiting for direction. Right after those dojis formed, a strong Marubozu candle appeared, showing that buyers had regained control and confirming the continuation of the uptrend. Now, here's how Munehisa Homa would interpret this setup. The dojis reveal uncertainty, a battle between buyers and sellers, while the Marubozu represents a clear shift in dominance. In his view, that transition from indecision to conviction signals that the market will continue moving upward. And as you can see on the chart, that's exactly what happened next. The market kept pushing higher. But remember, the Marubozu isn't only a continuation signal. In certain contexts, it can also mark the beginning of a trend reversal, depending on where it appears in the market structure. The next candlestick Munehisa Homma used was called Tonkachi, which means the hammer in Japanese. It appears after a strong downtrend and signals that the market may be preparing to reverse. Homma noticed that when the market keeps falling and suddenly prints a candle with a small body near the top and a long, lower shadow, it shows something important. Sellers tried to push the price lower, but buyers came in and completely rejected those low prices. That long wick represents rejection and strength from buyers stepping back into the market. He described it by saying, "When the shadow grows long below, it is the voice of the market saying, the fall has ended." In simple terms, the Tonkachi reveals a change in sentiment. It's the point where the market tells you that the sell-off is losing steam and smart money might be entering. Today we call it a hammer or bullish pin bar, and the psychology behind it is still the same. It shows rejection of lower prices and potential for a bullish reversal, especially when it forms at a key support or demand zone. Look at this real chart example. As you can see, the market was trending down, then it hit this level of support and reversed. After that, price moved down again, touched the same level, and this time a Tonkachi candle formed. This shows that sellers lost the battle against buyers and the market is now likely to push higher. And look at what happened next. The market went up exactly as expected. Now, let me tell you something important. We're not going to use Munehisa Homma's candles alone. We'll combine them with his Sakata 5 method, which takes candlestick trading to an entirely new level. But now I just want you to understand the anatomy and psychology behind these candlestick formations. Stay with me because later in this video, when we combine these candles with the Sakata 5 method, it's going to completely change the way you look at charts. Let's look at the opposite version of the Tonkachi, the Nagareboshi, also known as the falling star or shooting star. This candle forms after a strong uptrend and usually signals that the market may be running out of strength. When you see a candle with a small body near the bottom and a long upper shadow, that's the Nagareboshi. It tells a simple but powerful story. Buyers tried to push the price higher, but sellers came in and completely rejected those higher prices. The result is a candle that shows exhaustion. Buyers are losing control and sellers are starting to take over. In his writings, Munehisa Homma described it beautifully. He said, "When a light burns too bright, it cannot last till dawn." What he meant was that when the market rises too fast and too far, it's often followed by a sharp correction. The shooting star is the market's way of warning you that enthusiasm has reached its peak. Look at this chart example. As you can see here, the market was moving down and created this key level of resistance. After that, price started pushing up again, testing the same level once more. When the market reached that resistance area, a Nagareboshi formed. This candle shows that buyers tried to push prices higher but failed. Sellers stepped in, rejected those higher prices, and took control of the market. According to Munehisa Homma's logic, this type of candle signals that the trend is likely to reverse and start moving downward. And look at what happened next. The market dropped exactly as expected, confirming that this Nagareboshi candle was an early sign of weakness at the top. So while the Tonkachi represents buyers rejecting lower prices at the bottom of a downtrend, the Nagareboshi represents sellers rejecting higher prices at the top of an uptrend. Together, these two candles form the foundation of Homma's understanding of market psychology: fear, greed, hope, and exhaustion, the same emotions that still move the markets today. Now, the doji was one of the most meaningful candles for Munehisa Homma. To him, it symbolized a pause in the market, a moment of calm after strong movement, where both buyers and sellers are unsure of what comes next. When the market opens and closes at nearly the same price, forming that thin cross shape, Homma saw it as a sign that balance has returned, even if only temporarily. He used to describe it as the market taking a breath before speaking again. This pause can mean two different things depending on where it appears. When a doji forms after a strong bullish or bearish trend, it often signals a possible reversal. It tells you that the side that had control is now losing strength, and the other side might be preparing to take over. In that moment, Homma would not rush. He would wait for the next candle to confirm whether the market was truly reversing or just hesitating. But when a doji appears inside an ongoing trend, it's a continuation signal. It represents the market pausing to gather energy before continuing in the same direction. This kind of doji gives smart traders an opportunity to join the trend, not at the top or bottom, but during the brief moment of balance before the next impulse. In modern trading, we see the same psychology play out. A doji near key support or resistance levels can be a warning of reversal, while a doji in the middle of a strong trend is often a sign of healthy consolidation before the next move. Homa's lesson was simple. Don't fear the pause, understand it. The doji is the market's way of saying, wait, watch. The next move is being prepared. Look at this chart example. As you can see, the market was trending down, then it started to consolidate in this area. Eventually, price broke below the consolidation phase, and if you look closely, you'll notice a clear Marubozu candle. This candle is an early signal that sellers are dominating the market and that the downtrend is likely to continue. Right after that, a doji formed. And that's important. The doji indicates a pause in the market, a moment when both buyers and sellers are balanced. If you know how Munehisa Homa interpreted these candles, you can read them exactly as he did and make smarter trading decisions. Here, the Marubozu tells us that sellers are in full control. The doji tells us the market is taking a short break, not reversing, just resting before continuing lower. That pause gives you an opportunity to join the trend. When the doji closes, that's the perfect time to re-enter the downtrend with confidence, because you understand the message behind the candle. And look at what happened next. The market continued to move down exactly as expected. Remember, we don't use the doji alone. For now, I just want you to understand the message it provides. Later in this video, we'll combine it with the Sakata 5 method, and that's where everything will start to make perfect sense. Look at another chart example. As you can see, the market dropped, then reversed, creating this support level. After pulling back, price reached the same support level again and formed a doji candlestick. In this case, the doji indicates a pause influenced by a possible reversal. So remember, the doji doesn't only represent a pause in the market, it can also serve as a reversal signal, especially when it appears at a key support or resistance level. And look at what happened next. The market moved up again, exactly as expected. Now, let's move to the next candlestick pattern, the Tsutsumi. In Japanese, Tsutsumi means to wrap or to engulf. To Munehisa Homa, this candle wasn't just a pattern, it was a message of dominance. When one candle completely covers the previous one, Homa saw it as a shift in power. The stronger side, buyers or sellers, had not only fought back but erased the previous session's emotion completely. He described it as, when one day swallows another, the market's heart has changed. In simple terms, a bullish engulfing forms after a decline. The green candle covers the body of the previous red candle, showing that buyers have taken full control. A bearish engulfing forms after a rally. The red candle swallows the previous green one, revealing that sellers have seized control. To Homa, the engulfing candle wasn't just about size, it was about emotion. It meant that one side's conviction had completely crushed the other's hesitation. He often combined the engulfing with key levels or after a doji to confirm reversals. What he called the market's confession. In modern price action, the engulfing pattern represents a clear shift in momentum, a signal that the market is changing direction or gaining strength. At the bottom of a downtrend, it indicates a bullish reversal, showing that buyers have absorbed all selling pressure and are ready to push the market higher. At the top of an uptrend, it signals a bearish reversal, revealing that sellers have stepped in and taken control. And when it appears in the middle of a trend, it often signals a continuation, confirming that the pullback is over and the trend is ready to resume. Homa's principle was simple. The market's path